Welcome back to the channel. Today, we're diving into a topic that affects almost every aspect of our financial lives: interest rates. Whether you're saving money, borrowing for a home, or investing in the stock market, interest rates play a crucial role. But have you ever wondered why these rates fluctuate? What causes them to rise and fall? By the end of this video, you'll have a solid understanding of why interest rates move and how these changes can impact you. 1. What are interest rates? Let's start with the basics. What exactly are interest rates? In simple terms, an interest rate is the cost of borrowing money or the reward for saving it. When you borrow money, the lender charges you a percentage of the loan amount as interest. Conversely, when you deposit money into a savings account, the bank pays you interest. Interest rates are typically expressed as an annual percentage of the loan or deposit. For example, if you take out a $10,000 loan at a 5% annual interest rate, you'll pay $500 in interest over a year. Similarly, if you deposit $10,000 into a savings account with a 2% interest rate, you'll earn $200 in a year. 2. The role of central banks. To understand why interest rates change, we first need to talk about central banks. In the United States, the central bank is the Federal Reserve, often referred to as the Fed. Central banks play a key role in setting short-term interest rates, which in turn influence long-term rates across the economy. Central banks use interest rates as a tool to achieve their economic objectives, primarily controlling inflation and stabilizing the economy. When inflation is high or the economy is overheating, central banks may raise interest rates to cool things down. Conversely, when the economy is slowing or in a recession, central banks may lower interest rates to stimulate growth. Before we continue, remember to like the video and subscribe to the channel. 3. Factors that influence interest rates. Interest rates don't move randomly. They're influenced by a variety of factors, both domestic and global. Let's explore some of the most important ones. Inflation. Inflation is the rate at which the general level of prices for goods and services rises. When inflation is high, central banks often raise interest rates to prevent the economy from overheating. Higher interest rates make borrowing more expensive, which reduces spending and slows down inflation. On the other hand, when inflation is low, central banks might lower interest rates to encourage spending and investment, thereby boosting the economy. Economic growth. Economic growth, measured by gross domestic product, GDP, is another critical factor. When the economy is growing rapidly, demand for goods and services increases, which can lead to higher prices and inflation. To counteract this, central banks may raise interest rates to cool down the economy. In contrast, during periods of slow growth or recession, central banks may lower rates to stimulate borrowing, spending, and investment. Employment levels. Employment levels also play a role in interest rate decisions. When employment is high, people have more disposable income, which can drive up demand for goods and services, leading to inflation. In such cases, central banks may raise interest rates to keep inflation in check. Conversely, when unemployment is high, central banks may lower interest rates to encourage businesses to borrow and invest, creating more jobs. Monetary policy. Central banks use monetary policy tools to influence interest rates. One of the primary tools is the setting of the benchmark interest rate, often called the federal funds rate in the U.S. By adjusting this rate, central banks can influence short-term interest rates across the economy. For example, if the Fed lowers the federal funds rate, banks may lower the interest rates they charge on loans, making borrowing cheaper for consumers and businesses. Global economic conditions. Interest rates in one country are not immune to what's happening globally. For instance, if major economies like the European Union or China experience economic slowdowns, it can impact global trade and financial markets, influencing interest rates elsewhere. Additionally, central banks often consider global factors when setting rates to ensure their domestic economy remains competitive. Market sentiment. Financial markets also have a say in interest rates. For example, if investors believe inflation will rise in the future, they may demand higher interest rates on bonds to compensate for the loss of purchasing power. This expectation can drive up interest rates even before any official changes are made by central banks. 4. How interest rates impact you. Now that we've covered why interest rates go up and down, let's talk about how these changes can impact you directly. Whether you're a borrower, a saver, or an investor, shifts in interest rates can have significant effects on your financial situation. Borrowing costs. One of the most immediate effects of rising interest rates is the increase in borrowing costs. If you have a variable rate mortgage, credit card, or other loans, your interest payments may increase when rates go up. This can lead to higher monthly payments, making it more expensive to borrow money. Conversely, when interest rates fall, borrowing becomes cheaper, which can be a good time to take out loans or refinance existing debt. Savings and investments. Interest rates also affect the returns on your savings and investments. When rates are high, savings accounts, certificates of deposit, CDs, and bonds tend to offer higher returns. This is great news for savers looking to grow their wealth safely. However, when interest rates are low, the returns on these types of investments may decrease, leading some investors to seek higher returns in riskier assets like stocks. The stock market. Speaking of stocks, interest rates can significantly influence the stock market. When rates are low, borrowing costs for companies decrease, potentially leading to higher profits and stock prices. However, when interest rates rise, the cost of borrowing increases, which can reduce corporate profits and lead to lower stock prices. Additionally, higher interest rates make bonds more attractive, which can lead investors to shift their money from stocks to bonds, further impacting stock prices. The housing market. Interest rates have a direct impact on the housing market. When rates are low, mortgages become more affordable, which can drive up demand for homes and push prices higher. On the flip side, when interest rates rise, mortgages become more expensive, potentially cooling down the housing market and lowering home prices. If you're planning to buy a home or refinance your mortgage, keeping an eye on interest rates is crucial. Currency exchange rates. Interest rates can also influence currency exchange rates. Higher interest rates in a country can attract foreign investors looking for better returns, increasing demand for that country's currency and causing it to appreciate. Conversely, lower interest rates may lead to a depreciation of the currency. This can impact the cost of imports and exports, as well as international travel. 5. The long-term impact of interest rate trends. Interest rates tend to move in cycles, with periods of rising rates followed by periods of falling rates. Understanding these cycles can help you make informed financial decisions over the long term. Economic cycles. Economies go through cycles of expansion and contraction, and interest rates often follow these cycles. During periods of economic expansion, interest rates may rise to prevent the economy from overheating. Conversely, during recessions or slowdowns, interest rates may fall to encourage growth. By understanding where we are in the economic cycle, you can better anticipate potential changes in interest rates and adjust your financial strategy accordingly. Long-term financial planning. For long-term financial planning, it's essential to consider interest rate trends. For example, if you're planning to buy a home in the near future, understanding the direction of interest rates can help you decide when to lock in a mortgage rate. Similarly, if you're saving for retirement, understanding how interest rates impact different types of investments can help you build a more robust portfolio. Risk management. Changes in interest rates can introduce risks to your financial situation. For instance, if you have a variable rate loan, rising interest rates can increase your monthly payments, potentially straining your budget. To manage this risk, you might consider refinancing to a fixed rate loan when rates are low. Additionally, diversifying your investments across different asset classes can help mitigate the impact of interest rate fluctuations. 6. Current trends and what to expect. As of now, interest rates are a hot topic, especially with recent changes in global economic conditions. Central banks around the world have been adjusting rates in response to various factors, including inflationary pressures, economic growth, and geopolitical events. Understanding these trends can help you stay ahead of the curve and make informed decisions. Inflationary pressures. Many economies have been experiencing higher inflation rates due to supply chain disruptions, increased demand, and other factors. Central banks are closely monitoring these developments and may raise interest rates to keep inflation in check. Global economic uncertainty. Ongoing geopolitical tensions, trade disputes, and the lingering effects of the pandemic are contributing to global economic uncertainty. Central banks are likely to adjust interest rates cautiously in response to these challenges. Future projections. Looking ahead, It's essential to keep an eye on central bank announcements and economic indicators. Interest rates are likely to remain a key focus for policymakers, and staying informed can help you navigate the potential impacts on your finances. So, there you have it, a comprehensive look at why interest rates go up and down, and how these changes can impact your financial life. By understanding the factors that influence interest rates, you can make more informed decisions about borrowing, saving, and investing. Whether interest rates are rising or falling, having a solid grasp of these concepts will help you stay ahead of the game. If you found this video helpful, please give it a thumbs up and consider subscribing to the channel for more insights on personal finance and investing. Thanks for watching.